Welcome back. You're watching Trading Hour on CNBC TV18 as we hit all-time highs on the market, though off highs right now. But for for all practical purposes, we are at all-time highs for a lot of stocks. We bring you our special segment where we compare how valuations of stocks in each sector compare with their mean valuations. Are they overpriced by historical standards? If yes, by how much? What are the triggers? What is the sector deep dive? And today we have our eye on the agrochem and the specialty chem sector. Sonal is here with all the data. Sonal.
Thanks a lot for that, Mangalam. Well, yes, big moves coming in all these stocks. Let me start with the agrochemical space. Well, barring UPL, all the other stocks have risen sharply this year. UPL is down 23% this year, but from March lows, it has been a substantial gainer. In fact, for all the other stocks, it's a gain of around 87 to 170% this year itself. And for the year, all these stocks have done really well. And the biggest outperformer is Dhanuka Agritech, which is up around 82%. UPL, the valuation-wise, is the cheapest in the space. It trades at 10 times, being the biggest manufacturer of agrochemicals in the country. And in fact, from the median valuations as well, it trades at 10 times versus 16 times that it used to trade at earlier, largely because of the corporate governance issues that we've been seeing in UPL so far. But apart from that, we have PI Industries, which is higher than the peak valuations. Rallis India, however, trading lower than the peak valuations of 22 times. We have Bayer Crop Sciences. It trades at around 29 odd times, but it is higher than the peak valuations that we saw earlier. Dhanuka Agritech looks like still some legs for rally because it's trading lower than the median valuations earlier. Now, moving on to the specialty chemical space, the China factor has been working really well for them. The stocks have risen anywhere between 80% to 200% this year itself. From March lows as well, they've seen substantial recovery, and the biggest gainer in this list is Naveen Fluorine, which is up around 153 odd percent. The story around these stocks always has been high valuations, and if we look at the valuations right now, SRF, though it is trading higher, the valuations are still below the median valuations of 32 times. We have Vinati Organics trading at 36 times, and Naveen Fluorine, that one stock, is trading at 47 times, one of the most expensive stocks in this space, and it is much higher than the median valuations that we saw earlier. Deepak Nitrite, a very good gainer this year, however, still lower than the peak valuations. A lot of triggers going ahead. The demand in the sector is something that we'll be watching out for, especially in the discretionary space, and we see the demand from the end user sectors. Quarter 2 saw margin expansion. That is because of lower input costs, because of inventory buildup. That might continue in Quarter 3, but Quarter 4 onwards, there could be some cost pressure. So that is something we'll be watching out for. And of course, the China factor. How much of the demand actually comes from China to India, to these domestic producers, is something we'll be watching out for. Back to you.
Thanks, Sonal, for that. Let's pose all these questions to Rohan Gupta of Edelweiss. Rohan, morning, and thanks so much for joining in. You know, when we spoke to you earlier in the morning, you indicated that valuations of specialty chemicals and the stocks have run up because growth prospects have improved considerably. So after the kind of run up, the stocks are already factoring in a good earnings performance. From here on, where do you still have comfort? Where do you see upside? You like Aarti, SRF and Galaxy. Walk us through the reasons there.
Yeah, thanks Rima for having me here, and good morning everyone. Yes, as I also have highlighted in the morning that the fundamentals of across the specialty chemical sector has improved significantly. More so the reasons are that after the COVID pandemic, the world has turned against China, and that is further helping India to benefit from this specialty chemical growth scenario. All these companies, if we talk about Aarti, SRF, PI, Galaxy, Fine Organics, and all these companies have gained significantly in terms of global growth prospects about the specialty chemical. We are expecting a lot of businesses may move going forward from China, and India is the biggest beneficiary of that. No doubt, as Sonal also pointed out very well, that valuations across the sector has gone across the roof, and they are probably, some of the stocks are trading at new time high in terms of multiples as well. But that is not the end of the story. We see that the growth prospects, because they are so solid, that the visibility of these companies doing well is not only just limited for 1 or 2 years. We are expecting that businesses may continue to flow for next 5 to 10 years, and that's why I term all this specialty chemical story a decade story now. Year 2020 to 2030 can be a growth year for all these companies. Globally, we are still very small compared to all these companies when we compare it on a global background. That's why we see that there is a huge growth opportunity for for continuous growth opportunity in these companies. And if you see that in last 1.5 years, most of these specialty chemical companies, despite having very solid cash flows, have further raised money, whether it's a PI, SRF or RT, because they are continuously investing in the businesses. With this investment going ahead and the very high capex, this which we are seeing right now, is going to benefit all these companies over next 2 to 3 years. And that's where we see the story lies for all the specialty chemical companies. I'll just take you through very quickly. Our top picks in specialty chemicals are Aarti. It's a well diversified player. They cater to across the industries, whether it's polymers, whether it's textiles, whether it's pharma, across the sector, and have invested significantly in 2020 and 2019 and 2020. The benefit of that we are expecting that will come over next 4 to 6 quarters. Similarly, Galaxy, a completely business model, and they cater to FMCG. As you know that FMCG has gained significantly in this pandemic. They are catering to surfactants. With the rising focus of people towards hygiene, this company is a very solid beneficiary. We see that Galaxy also is going to compound almost 12 to 15 years in 12 to 15% in earnings over next 10 years. SRF, it's a diversified company with having presence in technical textile and packaging film also. But the key business of this company is specialty chemical. They have their capabilities, very solid capabilities in fluorine chemistry, along with getting into many other multiple chemistries. They are winning contracts across the world. They have gained customers across the global agrochemical companies. And that's where we see that SRF also is going to be a very strong beneficiary as far as its chemical and specialty chemical business is concerned over next 5 to 10 years. So all these companies, Rima, if you look at from the valuation for just 1 year, probably these stocks will definitely look expensive. And keeping 1 year or very short time frame, people may not like to invest this company only because of the valuation. But I don't ascribe to that theory because I think that the earnings growth are here to stay. We are expecting all these companies have a potential to deliver 15 to 20% earnings CAGR over a decade. And that's where the story lies in all these companies.
Fair point, Rohan. Thanks a lot for stopping by and giving us all those details. The argument's well made. It's a decadal story. So valuations, while they're high, notwithstanding from the growth opportunity that persists, and more importantly, the 3 picks that he has, Galaxy, Surfactants, Aarti Industries, as well as SRF, we will keep on our radar, not from a 1 or 2 year perspective, but like Rohan said, maybe a decade where a lot of the meat is still there. Thank you for joining in. With that, we'll step into a short break, come back, get back to discussing market technicals.